Today sees the release of Iliad's interim results for 2013. A 6 months period was characterized by pretty intense and competitive trading conditions. The group overall reflects revenue growth of 0.4% on the comparative period, clearly reflective of the fact that the market is still very competitive, and in certain regions some of the anticipated infrastructure spend that we've been looking forward to had not materialized. It's worth a while to talk to the different segments or divisions within the business, and these subdued turnover trends were reflected in most of our divisions. General building materials, inland and coastal, showing marginal revenue growth. Some of the regions performed quite well. Eastern Cape, a sound and a commendable performance for the first 6 months of the year. KwaZulu-Natal and the Western Cape, more of a subdued performance for the first few months. Inland, our Northern Cape and Free State businesses did have a good few months. Some of our other regions being, to an extent, impacted by the happenings in the mining industry and the spillover of that onto consumer confidence levels and also disposable income. We're very pleased that gross margins have been sustained for the first 6 months of the year, and that is despite some pressure on the finishing end of the business in specialized building materials. Specialized building materials, two issues to note of significant importance. Firstly, a successful 6 months for us in executing the disposal decisions we took at the start of the year. So 3 of our businesses, ceramics, which is mainly about the Ferreros brand, ceramics cash and carry, that's National Tile Traders, as well as our timber wholesale business, Thorpe in Gauteng and TPS in Cape Town. Those disposal decisions were implemented, all of them, by July of this year. As far as timber wholesale goes, a business that as a wholesale redistributor didn't quite fit in our portfolio, and that business together with the other 2 also over time unfortunately not achieving our business objectives, and having shown improvements over a significant period of time, unfortunately the performance trends in the recent months has not been positive, and hence a decision made in a difficult business environment to adjust our portfolio to provide a healthy platform for future growth. Having spoken about sustaining gross margins, it's also important to note that on the expense side of the business, we believe we continue to focus well on that. So if expenses for the group up by 3.7%, which is well below inflation. Having said that, if you have marginal revenue growth with sustained gross margins and below inflation rate increases, there is to an extent negative leverage on your continuing operations as well. Our future portfolio for the first 6 months delivered an operating margin of approximately 2.9%. With regards to the balance sheet, cash flow wise, significant efforts has gone into working capital management in the first few months of the year, and I'm very pleased to say that we are reaping the rewards of that. The last 2 months we've seen significant gains, and that together with the income from the disposals from a balance sheet perspective and a cash flow perspective, and enhances our position significantly, where as we speak we're significantly lower on borrowing levels compared to this time last year, not only because of the disposal income but also because of the gains in working capital management. Hence, earnings per share reflecting a loss that is strictly due to the impact of those disposals and the portfolio adjustments. The HEPS line showing a marginal positive result. Very importantly though, and very exciting for us, is we can in a very short period of time see the major benefits of having adjusted the portfolio, and on the back of some major success with various other key strategic initiatives, it's quite frankly a different business, and we are very positive of what the future holds for us. There's a lot of hard work by a lot of people that we believe will into the future deliver positive results. The trading environment, if we look forward for a few months, no switch on the wall that will enhance the trading environment overnight. It will remain highly competitive. After a very tough first quarter for us, we saw better revenue growth in the second half and second quarter, and I'm pleased to say that those revenue growths have continued into quarter three at approximately the 5% levels. So revenue growth at or just above the inflation rate, with a continued ability to sustain gross margins and manage expenses with this revitalized portfolio, makes us excited about what the future holds. And if some of those infrastructural, the indirect benefit we get from infrastructure spend and some of the dynamics in certain regions develops into a more positive reflection and in positive frames of mind of our customers and our consumers, we look forward to improving trends going forward.